Hello, my name is Anne Tarca and I'm a board member at the International Accounting Standards Board. In this webcast, I will discuss research evidence about the impact of using IFRS standards on international cross-border investment. The studies I cite are listed at the end of the slide deck. The International Accounting Standards Board, IASB for short, was formed in 2001 with the objective of developing a single set of high-quality, understandable, enforceable, and globally accepted accounting standards. Currently, these IFRS standards are required in more than 140 jurisdictions and permitted in many more. Our work serves the public interest by fostering trust, growth, and long-term financial stability in the global economy. It also helps investors to identify opportunities and risks across the world, thus improving capital allocation. This presentation addresses the following question. To what extent does the evidence about foreign investment indicate that the IASB is achieving its objectives? Support for adopting IFRS standards is based on the expectation that financial reporting using our standards will be of higher quality and more comparable than reporting based on varied national accounting standards. High-quality, consistent standards should lead to more cross-border capital flows and better integration of capital markets around the world. Proponents of adoption of IFRS standards say the change will improve the information available to foreign investors, thus decreasing information asymmetry between foreign and local investors, and increasing the visibility of some investments. Evidence shows that some foreign mutual fund ownership increased when firms voluntarily reported their financial information using international accounting standards. Benefits to primary users, large-scale investors who base their economic decisions about a company on its financial reports, were greater in settings where the investee firms were previously less visible and the information about them was of lower quality. Subsequently, evidence from countries adopting IFRS standards shows that the home bias of US investors decreased following implementation. The decrease was more likely when a country's national accounting standards were more different to IFRS standards, and when incentives to provide high-quality information were stronger. Research shows that, for a broad set of investors, a country's adoption of IFRS standards was associated with an increase in the amount of investment and the number of investors. That includes mutual funds, pension funds, insurance companies, hedge funds, private equity, and venture capital funds. Possible explanations for the effect are domestic investors increasing their stakes in response to high-quality accounting by the investee firms, and foreign investors attracted by the greater transparency in the financial reports of investees. Other research shows another measure of investment, foreign direct investment, increased following adoption of IFRS standards. The effect is stronger in developing economies, reflecting the influence of World Bank policies. The benefits of IFRS adoption may differ for debt and equity investors. In countries adopting IFRS standards, one study documented an increase in foreign debt investment, primarily from the US and other non-adopting countries. However, for foreign equity investment, benefits were more likely to be observed in countries with stronger governance and better protection of creditor rights, as well as with more economic development. The foreign debt investment was primarily from the US and other countries that had not adopted IFRS standards, leading the researchers to conclude the benefits of our standards for foreign investors come from improvements in the quality of financial reporting, rather than improvements in comparability. Other studies explain the benefits in terms of improved comparability. One study investigated whether reporting was more uniform within industry sectors after adoption of IFRS standards. The researchers found more investment by foreign mutual funds was associated with greater comparability within an industry. That is, globally, there were more industry peers using the same standards. Other researchers have pointed to benefits from familiarity with IFRS standards. They reported more foreign investment when countries shared language, culture, legal origin, and regional location. However, the strongest benefit arises when investors and investees both come from countries that use IFRS standards. Considering some more recent studies, researchers continue to find that specific country features affect investment outcomes. For example, legal protections, firm ownership concentration, and features of previous national accounting are influential features. A study of cross-border acquisitions reported an increase in acquisitions of listed targets in IFRS adopting countries. The investment flow came mainly from other countries adopting IFRS standards and was more robust when reporting uniformity was higher. Researchers conclude that investors value comparable information that assists their analysis of firms and their global peers. Consistent evidence is provided from IPO markets. After a country adopted IFRS standards, both domestic and global IPOs showed less underpricing and more issue proceeds from foreign markets. These benefits, however, were associated with countries with fewer accounting differences to IFRS standards and stronger legal frameworks. Another study investigated cross-listing and found the propensity to cross-list was higher after adoption of IFRS standards. Firms from countries that adopt IFRS standards are more likely to cross-list in other IFRS adopting countries and in larger, more liquid markets. The benefits of adopting IFRS standards showed more in countries where the accounting change was greater, prior disclosure was lower, and firms had more limited access to capital. At the beginning of this presentation, I mentioned the expectation that benefits in the form of increased cross-border investment were expected to follow from the adoption of IFRS standards because of the potential of our standards to improve the quality and comparability of reporting. The research I have referred to in this presentation does indeed provide evidence that adoption of IFRS standards is associated with increased foreign investment. The findings, mainly from years following adoption of IFRS standards, consider many countries and forms of investment. The evidence is consistent with the IFRS Foundation mission of issuing standards that promote transparency and efficiency in financial markets and growth in the global economy. An important conclusion from the research is that benefits of adopting IFRS standards for foreign investment do not occur uniformly and are likely to be influenced by two groups of factors. Firstly, the quality of the standards. The challenge for the IASB is to continue to produce high-quality standards to meet the needs of primary users of financial statements. Secondly, each country's institutional setting. By this I mean the legal institutions, enforcement bodies, and corporate governance requirements that provide mechanisms to protect investors and to promote high-quality reporting. In conclusion, the evidence suggests that the comparability and transparency benefits from IFRS standards are fundamental to growth in foreign investment. However, benefits of adopting IFRS standards are potentially greater when supported by appropriate and effective institutions in adopting countries. Therefore, the IFRS Foundation works with a range of national and international bodies to ensure successful implementation of IFRS standards that will bring transparency, strengthen accountability, and contribute to economic efficiency across capital markets.